Sir, you call yourself a financial transitionist. What does it mean?
So typically things like death, divorce, sale of a business, becoming empty nester, retiring, all these are big transitions, and I think there's a number, if I recall, maybe 40, 50 transitions which each of us will go through in our lifetime.
In the current times, why do people earning 20 lakh or more per annum also struggle with money? Why do you think so?
So the answer has not changed since even 2006. I think the first thing to do is to protect risk. So if you do not have health insurance, then buy health insurance. I think mutual funds is a boring and not so sexy way of investing. Unfortunately, younger generation thinks that, futures and options, I will take 1 lakh or 70,000 and buy worth 5 lakh. Sort of fetish that people had about star fund managers and say, okay, we will follow that fund manager. When we look at, past returns from maybe the last 20, 25 years, and we look at the top, let's say a 3-year performance, and you look at the funds, how they have done in 3-year performance, and they are in the top quartile, only 1/4 of them in the next 3 years remain in the top quartile.
Sir, what are the biggest behavioral mistakes that you see in young investors? My guest today is someone who was thinking about financial planning before most Indians even knew the term existed. With nearly 3 decades of experience, he is one of India's very first certified financial planners, the founder and CEO of International Money Matters, and a winner of the Global Plan Plus Financial Planning Award for Asia. He's not here to sell you a product, he's here to change the way you think about money. Today we get into everything: myths, markets, mistakes, and the money behaviors that quietly make or break your financial life. So welcome to the show, Mr. Lovaii. So you've been in the personal finance space for 3 decades, handling clients across 15 countries and assets under advisory of 3,000 plus crores. If you could tell more about what International Money Matters, your company does, and what your role is as a founder CEO.
So thank you for having me. I started this in 2001, primarily because I think there was nobody who was looking at the interest of clients when managing money. Awareness was very low, and it was important to educate clients about their personal finances. A few years after that, financial planning came to India, so I happened to be in the first batch of financial planners in the country. And it was very exciting to calculate goals and inflation-adjusted retirement corpus and stuff like that. But it started from there with Indian clients, Indian products. Then some clients moved abroad, so NRIs with their Indian products. Once we got into financial planning in a deeper manner, we recommended to clients to diversify overseas. So it became Indian clients, but investments outside, and outside non-residents investments inside. And then over time, it sort of moved to a much broader sort of spectrum where there were people who were outside the country and they were investing also outside of India, and we were helping them with their investments. And while doing this, it was important to look at risk. It was important to look at tax aspects, reporting, currency movements, and therefore connect with other professionals. Could be advisors in other countries, could be chartered accountants, lawyers, to help create wills, trusts, all of that. So, yeah, it's pretty all-encompassing, I must say.
Great. So someone comes to you, you kind of give a 360-degree solution for the personal finance space broadly.
Yeah, so I think if we gave it to everybody, they'd probably get overwhelmed. So it's sort of a slow introduction, because sometimes people come in with specific requirements. I have a certain amount to invest and I must do it in the next 2 days. So if I started trying to get, the whole detail at that point in time, the whole investment process would be delayed and they would probably move somewhere else.
Sir, you call yourself a financial transitionist. What does it mean?
So this came much later, probably about a decade plus into business. a very close friend of mine lost her spouse. And I was struggling with the meetings that I was having with her. And I met this bunch of people in US at a conference who were in this business of handling transitions. And they call themselves certified financial transitionists. And I had the same question, what does that mean? So we figured that people going through major life change typically spend very little time using rationality for decision making. It's all emotional. And therefore, to understand what stage of transition they are in, therefore, what type of tools we could apply, primarily with the focus of keeping the client in a safe place so that they don't regret any decision that they took or did not take. And also helping them to zoom out and look at their situation. So typically things like death, divorce, sale of a business, becoming empty nester, retiring, all these are big transitions. And I think there's a number, if I recall, maybe 40, 50 transitions, which each of us will go through in our lifetime. Yeah, so I mean, let's say you were studying, then you decided to start working, then you moved city, then you moved job, then you got married, then you got a child. Each of these is transition. And if you actually spend time noticing yourself when some of these things happen, you will find that you probably do one of two things when this happens. One, you have many things to complete at that time and you just don't know where to start, so you don't do any. Or then you take all of them and say, I have this 1 hour, I'm going to finish all the 20 items which are on my list, without really spending enough time on each of them. But you're not doing something like, okay, let me focus on what really needs to be focused on now. I can push back decisions on certain things. So the Transitionist program actually teaches us to understand human emotion, and in some way it helps even in financial planning, because you make a plan, people don't act on it. So here you can understand why they're not acting and then figure out what is it that you have to do to nudge them to act.
So from here, let's move to mindset and myths. Our parents advised us to invest in gold, real estate, fixed deposits, and they always asked us to avoid debt at all costs. Which of this advice is completely acting against us, this generation?
I think all of them. So I think we have to recognize the fact that they grew up at a very different time. So you think back 2-3 decades ago, I don't think there was enough wealth available unless you were sort of, getting it bequeathed, right? Otherwise, there was no wealth. Therefore, your goals were simple. One of the key goals was, how do I save tax? Because the government also had schemes in which you said, okay, if I put so much money, I'll save the tax. And I had limited resources. So I also know that my father bought an insurance policy for me. And the moment I got promoted, somehow the insurance agent seems to know very quickly. And he dropped by and said, oh, now your son's got promoted. Why don't you buy higher insurance? And in those days, there used to be the tax breaks. I think Section 88 or 80C, one of those. And I remember my father telling him, I want a policy which will have premium of 28,450 rupees. So you took policies because that investment would save you some tax. Of course, it gave me very limited amount when it matured and really at the wrong time. But yeah, I think what you grew up with was different. The stock market was full of scams. It was not digital. It was 15 days to settle your stock. And by the time you settled, which might have been many, many months later, you found your signature is not tallying. Right? So I think so obviously they were worried of even the stock market. They say, let's just put in fixed deposit and we are fine with those sort of rates.
So also in one of our personal conversation, I remember you telling me about one financial advisor who sold his old Santro to buy a new Santro. Why did he do that, and what did you advise him?
No, so he was not seeking my advice, but we used to meet in the early days of, mutual funds houses calling us and saying there is big scope in mutual funds, you should recommend them, etc. And one of those times, the person I knew in the space, in those days they were not called advisors, there was no such space, so we were just what we called ourselves IFAs, independent financial advisors, what today is largely called mutual fund distributor. So everything was based on, earning was based on commission. And he said, oh, I bought a new car. And I asked him which car. He said, Santro. And I said, didn't you already have a Santro? He said, yeah, but I didn't want my clients to know that I'm making money. And what I had learned at that time, more from outside the industry than from inside, that in this business of wealth management, it may be a good idea to show to your client that you are in a position to make money for yourself, and therefore you are confident you can make money for them. So I found it a little odd, but I think those are days of very little transparency. So you didn't want to show that I was making. If I have not told my client that I'm making so much on the investments that you're doing through me, I am hesitant. I'm guessing the client was smart enough to know that I'm not doing this for charity, but I don't know why there was this hesitation in the past.
In the current times, why do people earning 20 lakh or more per annum also struggle with money? Why do you think so?
No, I think the answer is very simple. I don't think we are taught how to deal with money in schools and colleges. And I think till the time that we get to that stage, this is going to be, let's figure it out ourselves. Maybe we'll read a book, we'll read some newsletters of Warren Buffett or Howard Marks and say, oh, this is what they say. But frankly, there is no sort of simple understanding of the questions that I should ask. And I think that's very important. So I think people then come with their own experiences, egos, bad and good experiences, and then therefore struggle. And I don't think it's to do with 20 lakh. It will happen to 20,000, it will happen to 20 crore.
Sir, and again, with 3 decades of experience advising people, you would have seen multiple ups and downs, stock market, the bull run and the crashes. During crashes, what do you advise people to keep them off the ledge?
So I think it's what you tell them much before that.
Okay.
So I think the problem comes is if I promise you that if you come through me, I'm going to give you 20% return or 35% or whatever number you like. But I have not explained to you the risks. I have not explained to you the assumptions that I'm making in telling you that you may or may not get this return. So what we do is we end up looking at all clients with a financial planning lens. We certainly get a risk profiling done even if we are not doing a financial plan. So we have boundaries and then we try and hold them within the boundaries. So when things are going well, the client who is otherwise comfortable with a, say, 50-60% risk exposure wants 80-90% because he sees, I'm missing out.
That FOMO is created,
Yeah, this looks like no gravity, this will keep going up, right? And the reverse happens when things go down, right? Even the one with 50-60% wants to be zero. In many cases, zero. And I think what we've figured is that 0 and 1 doesn't work. Because then it means that you are a superb astrologer, soothsayer, predictor, and therefore you know when is the bottom, when is the top. And people don't act at that time, right? I mean, ultimately you're the investor and you have to act on it. I may believe many things, but you may not act on it.
Sir, what's 1 or 2 financial products that typically the industry sells that you and your team would never ever advise to your clients?
So the big thing over the years was NFOs because we found that, people were coming in with new products and again, because of lack of understanding, the feeling was that it's like a stock. Oh, it's available at 10 rupees, so it's great. And, we used to struggle to explain to clients that let's say a fund has been in existence for the last 3 years and that NAV is 20 rupees, and a new fund is coming in and is buying exactly the same portfolio and it's 10 rupees, really there's no difference, right? But unfortunately, people believe that. Now, unless it's a new category and you need some exposure to that category or it's a good category, then some exposure we might do in an NFO. That's very rare.
And let's get into investment basics. So someone is an just finished out of college, joined work as an young investor. He has saved 1 lakh right now. Over a few months, he has saved 1 lakh to invest. In the current times in 2026, what would be your advice in terms of, say, I know 1 lakh is a small amount in terms of asset allocation to start with, and consider him to be a medium or him or her to be a medium to high risk profile. Yeah. How would you want to go ahead?
So the answer has not changed since even 2006. I think the first thing to do is to protect risk. So if you do not have health insurance, then buy health insurance. If you are the only earning member of the family, buy life insurance. Then look at your cash flow needs and say, okay, my monthly expenditure is X. So 2 months or 3 months of expense, I'll just park in a emergency fund or a liquid fund.
So again, say, even if I'm staggering, when you mention equity, do you recommend someone to start with mutual funds route or direct equity route?
I think mutual funds is a boring and not so sexy way of investing. Unfortunately, younger generation thinks that, futures and options, I will take 1 lakh or 70,000 and buy worth 5 lakh. Very dangerous. We would not advise that. And there is a lot of data which talks about 90% of the people losing money. But you always think that you are in that 10%, right? So the only thing that happens at the end of it is now that 90 becomes 91.
Right. So F&O, I have heard many stories of people having burnt their hands. I've never known. You would be, as a financial advisor, being in the space, do you know of rich, wealthy people who have made money purely through F&O?
So let's understand this, that who's the one person who will make a lot of money in F&O is a broker. Guaranteed. He is very happy getting you to transact every day and show you excitement that today, this sector is doing well and tomorrow that will do well, and now, sell this and move there. And if I take that same rupee of yours or 100 rupees of yours or 70,000 rupees of yours and I roll it around 18 times in the year, because I'm making money on 12,60,000 and not on 70,000. So no wonder they're very happy with the younger generation keeping on doing this.
So, and sir, how important is time in the market vis-a-vis, timing the market? Just a couple of minutes ago, you were talking about, staggering it over a period of time rather than, trying to become a Warren Buffett in terms of timing the market. Even he doesn't time, he believes in staying longer. How important is that?
I think it's important, but I think in every individual, just because of the way our brains are structured, you should have a core part, which is longer term. And then you should have a satellite part, which you say, okay, this is what I will take a call on and say, okay, today it is looking like technology may not be a great sector. Let me take out money from there and let's put in pharma or let's put in banking or whatever sector you feel. But there has to be a very small element of that. And that's more for keeping you employed and engaged and excited, right? Otherwise, it's boring stuff, right? Staying invested, because you'll meet many advisors who say, no, right now, in fact, as there is uncertainty in the globe, you see so many narratives of stay the course, stay invested. But if you have not been advised right and you've put money into equities, which you needed in the next 2 weeks, 4 weeks, then it's very difficult for you to follow this advice, right? Because you're worried that 1 week later it's going to be further down. I might as well cut my losses and get out now.
Yeah. So once now that you advised me to go ahead with mutual funds and I've taken that advice, how do I end up choosing the right mutual funds? What is your advice for investors to?
It's difficult, frankly, because the tendency is to look at the rear view mirror. And that is fraught with a lot of danger. We'll come to that part later. But therefore, if you do not have a good advisor, you have not read enough, starting point is simple index fund if I want to put money in equity. If I feel that no, I don't know whether I want equity or debt, there are dynamic asset allocation funds. Put the money there because the fund manager will reallocate money from there. The other thing that works today in the current market is multi-asset allocation funds. So you will get some exposure to REIT, some international, some gold, silver, along with your debt equity. So you'll get a flavor of that. And I'm guessing that if you are just starting off and you do not know, amounts are smaller. And even if you have, say, only that 70,000 rupees to invest, maybe start with 25,000. We spoke of emergency corpus. I used to recommend this to people right from the beginning, and I still do. That let's say for emergency corpus, we are saying liquid fund, but you've never invested in mutual fund before. So you feel, no, I'll leave it in the bank or I'll put it into 15-day FDs and keep rolling it over. Right? So what I'd say is, okay, let's take 15,000, 20,000 rupees, put it in a liquid fund. After 4 days, redeem 4,000 rupees, some small amount. See the process. Once you've experienced the process, now you start feeling comfortable that, yeah, okay, it was easy to do. No, it was complicated. Oh, I needed to give an OTP. It happens only before 3 o'clock, whatever concern. But you get over that and reinvest and then look at the statement. That's the best way to learn, I would think. So you were asking earlier, how do you invest in a mutual fund and how do we invest or recommend mutual funds? So we would look at some of the past data. But the past data is not just, here's the return over the last 1 year or 3 years, whatever. We'd look at rolling data. We would look at different periods in time, how that particular fund has performed in a bull phase, in a bear phase. Then a whole bunch of statistical ratios, which my research team is better equipped at. I'm really bad at whatever, Sharp, Sortino, all of those they would look at. And then importantly, we will talk to the fund manager to understand why they did what they did in the past. So we're not necessarily ruling out fund managers who have not performed well. If they performed badly, but they've learned from that mistake, it's something that we would consider if all other factors are going well. So those are important pieces that we look at. It's, one has to remember that you make investments for the future and not for the past, but we are only looking at the rearview mirror and deciding where to invest.
So when you as a team advise, you look at the overall fund house, the fund manager, the particular scheme and the track record and multiple other things before recommending.
Yeah, whole bunch of things. And, in the past, there used to be this sort of fetish that people had about star fund managers and say, okay, we will follow that fund manager. Various fund managers in the past who did very well for some time and then started underperforming. We were more concerned with what is the process that was being followed, because if it's dependent on an individual, you have to remember that there is an ego. We are a human being. Ultimately, we want to rationalize and prove why what we have done is right. So I think you have to be a bit careful about that. So when we look at, past returns from maybe the last 20, 25 years, and we look at the top, let's say a 3-year performance, and you look at the funds, how they have done in 3-year performance, and they are in the top quartile, only 1/4 of them in the next 3 years remain in the top quartile. We've also looked at situations from, again, 2002, where if you have invested, if a fund was in the top 30 in a 3-year period, the next 3-year period, you'll be surprised to know that probably 2 or 3, or sometimes if you're lucky, 4 funds out of those 30 remain in the top 30. In the most recent data that we have, the second best performing fund in the previous 3 years, in the most recent 3 years, is ranked 202. It was 2 3 years ago. It's 202 in rank. And here I'm combining large, mid, small together. And of course, SEBI has done a good job of segregating, classifying now. So you can actually take the right comparisons of large cap. They will only be doing large cap. In the past, the fund managers would take discretion with 20, 30% of the portfolio and end up showing much higher returns.
If you could just help me understand the difference between a flexi cap versus a multi-asset allocation mutual.
So in a flexi cap fund, basically the investments are to be broken up into large cap, mid cap, small cap. Whereas in the multi-asset allocation fund, it has not just equity, but it has debt, it has gold, silver, it has international, it could have REITs. So those are the differences, yeah.
What the difference between a regular liquid debt fund vis-a-vis liquid arbitrage fund?
So, once in 2023, the debt tax rules changed. Liquid funds then became taxable at your normal interest rate, tax rate, right, at your slab. And so if people are at 30%, they are paying 30% on 6 or 6.5%, whereas an arbitrage fund was delivering 6.5, 7, but it was treated as equity from a tax point of view. Now, of course, from April now from the last budget, STT has gone up, so the return of arbitrage has come down, but it's still from a post-tax basis still a better option than liquid to temporarily park money.
Got it. So from here, let's shift to building a portfolio. In my 40s, I want to look at investment for 10 years. I readily want to invest 10 lakh rupees to go with, again, over a period of time. What is the asset split that you would recommend for me with a person with a medium to high risk profile?
We don't work that way. What we do is that we will not stop at 10 years. We will talk about lifetime. Because we are saying that, okay, it's possible that you might live till 100. Tell us when you will retire, what you would do, how much will your expenditure be, and then do the investment planning based on that. So one is on goals, one is on risk profile, and then the third element of what our view on the market is at that present point in time.
So also, once this analysis is done, then you would talk about split between, say, equity, gold, and other commodities. And
yes. So typically, what we would do is that we would allocate normally about 5% to gold or gold and silver in normal times. When uncertainties sort of go up, we are okay with pushing that up to 10%. We would definitely have international in the portfolio recommended. That could be 10-15% of the equity allocation. So if your equity is 60%, then we will say 10% can be international and 50 can be domestic. Then for debt, because I want some safety, because of the tax composition, the tax issues, we will not have a direct debt fund, but we'll try and get it through, let's say, a multi-asset or a dynamic asset allocation or a hybrid fund. And in hybrid too, you can get less aggressive to more aggressive hybrid funds. So an equity savings type of product has 15 to 25% in equity. We could park some money in that so that I still have debt exposure and lesser volatility more than anything else.
which are the three sectors that you personally feel have the greatest potential, say, in the next 10 to 15 years for our country?
See, I think if you look back, I don't think there has been any sector which has held as number one or number two for a long period of time. So we know that their markets will go through cycles. And if we believe that there is growth in the Indian markets, probably the banking finance sector will contribute to it. But if you have looked in the more recent past, private sector banks have really not gone anywhere, probably lost more than the market as well. So frankly, it's difficult to take a call on a 10-15 year basis. So diversified mutual funds have a big advantage because what they will do is they will allocate money, and if tomorrow there is, let's say, pharma is out of favor and banking is in favor, they will automatically reallocate. When they sell that stock and they buy that stock and there is capital gain, they are exempt from capital gain. So you as an investor, the diversified equity mutual fund. So you decide whether you want to be in multi-cap, flexi-cap, large-cap, mid-cap, small-cap. Again, it may be good to, if you have not had experience, to have a large portion in large-cap and blue-chip. Mid-caps do give you a little higher return. So maybe a large and mid cap as a combination could be a good combination for people who are going beyond, say, index funds as the next step to invest in.
Got it, got it. So in one of our earlier conversations, I remember you telling me that murders happen in P&L and dead bodies are seen in the balance sheet. And why do you say so?
No, I didn't say so. Actually, a PMS manager spoke about it, saying that's the way they evaluate. They were talking about, let's say, a company which was rivaling, say, Titan in the same industry. And they said, wow, it's doing as much turnover as Titan. But then you look in the balance sheet, you find there are no stores that they own. You look in their P&L, you don't see any rent for the stores. So they're wondering from where this sale is happening. And they realize that some of these things you sort of play around with. You know, in the good old days, there have been scams which have been found where raw material bills were fake. Sales invoices were fake. So the P&L looks nice and healthy, but somewhere along the way, if you do a little forensic audit, you may find the dead body.
Got it. So from here, let's move into the human behavior when it comes to money, right? So what are the biggest behavioral mistakes that you see in young investors straight into the first jobs?
I think lack of awareness is one part, and being in a rush to onboard whatever ship or plane they are wanting to get onto without understanding the risk.
Okay.
And then not having the discipline. I think what happens is if you're playing in T20 style in a test match, it's not going to work.
Got it. Got it. So this is the young investor. Now you work with, say, HNIs and you've been in this industry for long. What are the one or two mistakes that those people also make, which could be different from what an young investor would make?
I think the biggest one is sometimes that they don't know that they don't know. And as you sort of grow in stature, there is an element of ego. Maybe you've not had great experience when you have gone to an advisor or an intermediary. So now you want to control stuff. You want to diversify, in your mind, diversify by distributing your money to 2 or 3 wealth managers. Not realizing that all 3 are doing exactly the same thing. So there's no diversification. So things like those, I think we see happening.
And sir, and what are the great behaviors that typically HNIs have? And what is the definition of HNI in India? And what are the great behaviors that they exhibit that they stand out when it comes to managing money vis-a-vis an investor?
So I don't think there's a definition of HNI that different things people take into account. So frankly, when people would ask us that are you dealing with HNIs, we would say we are dealing with I. We don't know what HN stands for, frankly. Because for everyone, their rupee and their earning is important. So there is no, it's not that, somebody earning less, we should pay less attention to. In fact, for those people, the value of the money is a lot more because they don't have excess. For people who have excess, maybe they don't have as much value for money. So I think the good behaviors, frankly, ultimately boils down to discipline and getting into investment, knowing that this is my aim and intention. And when I reach my stop, I get off. Not that, I reached my stop early, so let me go. My ticket is valid for 24 minutes. This is now 18 minutes. I'll go 6. But that's not the stop you wanted to get off at. But, you tend to do that. So I think that those then become problems, if you ask me.
So from here, let's move to advanced products. So if you could just help our audience understand what is a PMS, what is an AIF for people with more money to invest in.
So portfolio management scheme is essentially a fund which is created by a manager or a team which says that I will invest in this particular way where minimum investment is 50 lakh of rupees. They could have higher minimums as well. And their intention is to make what we call as alpha, that I'll beat the index and I'll do much, much better than the index. So you tend to have the portfolio a little more concentrated than a mutual fund would be. So you might have 20, 25 stocks in the portfolio versus a diversified fund which may have 60, 70 stocks in their portfolio. Or even index, let's say you put into Nifty, it'll have 50 stocks. This may try and say, okay, let me bet on the 15, 20 out of that Nifty, which will do very, very well. And sometimes you do it well and sometimes you don't.
Yeah. And what about AIF?
So AIF, basically an alternate investment fund. And there are categories. So you could be in the public market, you could be in private market, you could be in debt. So different types of AIF. And there the minimums you normally are rupees 1 crore. The difference between the two is that in the PMS, the investment is in your name. So any buying, selling, the capital gains passes on to you, dividend income you add to your tax returns. In an AIF, it is taxed at the fund level and you get everything post-tax. But because the fund is treated more like a trust, so the tax rates are slightly higher. But it eases out the inconvenience of filing tax returns and advance taxes. So some people like some advantage because of that, even though the costs are slightly higher.
Are there any other advanced options for HNIs other than PMS AIF outside of?
Yeah, I mean, there are private equity, unlisted space. There are funds now available in that space, international for sure. And then in international, you get exposure to certain categories of investment which you may not have got exposed to at all in India. So you could get multiple broader options, I would say there.
So from here, let's move to commodity and other alternatives. Gold has spiked significantly higher in the last 2 years. It has done the job what typically equity should have done. Do you still recommend, like the way you were earlier telling, do you still recommend that everyone should have like say 5 to 10% of their portfolio invested in gold and silver?
So, in the early part of last year, in early 2025, we did recommend that we increase gold exposure from 5 to 10%. So we were a little early with that call, probably. And then somewhere in 25, we started getting options to invest in silver also through the financial route, either a silver ETF or a silver fund or a gold and silver fund in combo. So we started recommending those. Yes, silver did, in fact, even much better than gold. And our call to stay at 10% remains. But because of the spike that has happened, it's probably in some cases even gone as high as 12, 13, 14%. In those cases, we have actually spoken to clients to say, why don't you cut exposure? Because again, we are looking at it from an allocation standpoint. And again, looking at rear view mirror, just because they've given great returns in the last 2 years, no guarantee that it will continue doing that. In fact, we don't think that it will give as much return despite all the uncertainties. Because then now there is a play on dollar and oil and all of those which are playing a role in gold prices actually have softened a bit in the mid of March in 2026 now.
So also, do you recommend clients to invest in other commodities like outside of gold, silver, to say maybe copper, oil, or those kind of commodities? Do you?
So what happens is in the financial product space, these are available in the international market. So if you do have the ability to invest overseas and then you can take exposure, then yes, a little bit you could do that. But we don't have enough, I would say, data on how well they have done and in what periods and what caused the swing. I mean, you can see the return, but I think multiple factors play a role in that. So,
Okay. Shifting from here to real estate, sir, what is your view on real estate, buying a home versus renting a home?
I think the buying a home is a very emotional decision. There's a fair amount of security with buying if you're going to live in that home. Also depends on your life stage. So when children are younger, you know that the school is fixed and you're likely to be in that place for the next 10 years or so. At that stage, it's great to buy the home. And then a few years later, you suddenly realize, oh, now the children have left and you're not even visiting some parts of that home. So at that stage, you start re-looking at that element. But this whole piece of I will have multiple homes because I will rent them out and get income, one needs to be a bit careful about overall allocation between physical and financial assets. And as long as it's within a reasonable band, maybe 20 to 50% without counting your home that you're living in, that may be okay. But beyond that, one would be careful. Also, we have to take into account the generational change. I think the younger generation is no longer interested in owning and living in a home or getting tied down with one home and one city and all of that. So we see a lot of older clients actually disposing of properties that they have bought with the intention that, this will go to child A, this will go to child B. But child A has gone to US and child B to New Zealand. So they don't want to come back to Mumbai or Bangalore or wherever they are.
Within real estate, do you recommend, commercial real estate over house?
It depends on the quantums and how much you are in a position to invest. Commercial real estate, you tend to get comfortable saying, okay, here is a long-term tenant, here is this MNC which has rented out this place, so I'm going to get rental income forever. But there is never, forever. So when it gets vacant, if there is a downturn in the economy or that industry and they vacate, it might take a long time to get it refilled. And the same thing is true with residential as well, particularly if it's a very sort of expensive home or very unique home. That this is great for CEO of an expat company. Now, if there is a downturn, then no CEO is coming for a while. So, or their budgets are slashed.
What do you think are 3-4 things that every parent should teach their kids when it comes to personal finance?
For sure. I think they should give them some money to invest. If they can connect to a good intermediary advisor, let them sort of experience that, get things bounced off from them. I think all of that needs to happen. I think the ability to understand budgeting it becomes very important, particularly in the metros when children go abroad for studies and suddenly it's the first time now they have to figure out money on their own. And it's in a foreign currency and, with a whole bunch of new rules. But at least they have gone through budgeting as a process. Those are things which will be very, very useful.
Just a quick rapid fire round. I have jotted down a couple of questions. So, one, FD or mutual fund for a 30-year-old?
Oh, mutual fund.
FD or mutual fund for a retired 60-year-old?
Mutual fund, because I think you have to remember mutual fund come in varieties. So you don't have to be in equity. And my example to people would be on FD. Sorry, it's a rapid fire, but I'm going to take a minute. In fixed deposit, what happens is you are earning 6%. You are in the 30% bracket. You're getting 4%. Let's say your inflation is 5%. Your inflation, not what government is declaring. 100% of the time you're losing value. So the risk is much higher in that. Even if you assume that you put money in equity and you'll get it right only 10% of the time. At least 10% of the time you'll make more money. Here though, you're definitely losing money. So,
one sector you would put your money in right now?
International.
Any specific country?
Non-US, preferably emerging market, maybe China.
Okay. Any couple of mutual funds which invest in these?
Yeah, there are funds which invest in China.
Couple of them that you could...
I think currently the one that is taking money is Axis China Fund, if I'm not mistaken. Many others are sort of the limits are reached, so they don't take money in. So you have to wait till it really opens and then you can invest.
Okay. Crypto, yes or a no?
I don't understand it enough and there's not enough rules around it, so no.
Okay. The most overrated financial advice ever given by others or that people typically hear of?
That I am the hero and the expert and I know everything.
Gold an emotional asset or real investment?
The real investment, but it needs to have an allocation. You can't go overboard with it and you can't not have it.
Sir, the biggest financial lie the middle class tells itself?
I think that they'll be conservative with everything. So we are middle class, we are conservative. But I think as human beings, we all have the tendency to be misers in certain things and blow the money in certain things.
It's the same middle class that invests in F&O also, right? So the kind of risk
Yeah. But I'm saying that, you might haggle with your vegetable vendor, but you will not think twice in buying a fancy pen or a fancy phone, as an example.
Yeah, sir, 3 financial books that everyone should read.
Because I like the behavioral side, I think Daniel Kahneman would be top in my list. And in the Transitionist program, we have a clinical psychologist who's written a book called Advice That Sticks.
Advice?
Advice That Sticks.
That sticks, okay.
Dr. Moira Somers. And Thinking Fast, Slow, Thinking Slow by Daniel Kahneman. These are a couple of things that I...
If this conversation made you think differently about even one financial decision, it did exactly what it was meant to do. Share it with one person who needs to hear this. A friend, a sibling, a parent who still puts everything in a fixed deposit. Sometimes the most valuable thing you can do for someone is point them towards the right conversation. If you want more of these, subscribing is the simplest way to tell me to keep going. And to leave a comment telling me what hit home, what surprised you, or what you want to ask next time. I read every single one. See you in the next one.